Hi, this is Efrem Hoffman broadcasting live from NakedSwanTrading.com on Tuesday, May the 29th at 6:46 a.m. pre-market. What you're seeing on the screen right now is a picture of the E-mini 13-minute chart with a high-definition risk map overlaid on top of that. Okay? And basically what this map is showing, it's showing the zero momentum balance points for each time horizon as it projects forward into the future. Okay? And you could see there's a tight confluence of these boundaries between the 1330 area and the 1315 area. So right now we're kind of in the middle of that zone. So there's heavy resistance up around 1333 in the near term, and it's going to be difficult to get above there. So basically during the day on Tuesday and going into Wednesday, we'll make updates in the event that there's any kind of news that pushes us into that territory, and then we'll drill down to the 1-minute chart and focus on what the risk map is telling us so that we could take short-term trades with smaller risk but still trying to get the longer-term reward. Right now, a very critical area and is indicated at the 13-1750 area, where you see this purple line overlapping with this teal boundary, and that's right around that 13-1750. I'd say about 13-1725, to be safe. And what that means is if price trades underneath that level for 13 minutes or more, okay, at any point going forward into let's say the close of today, then we could get a very strong downdraft, especially once price gets underneath the 13-14-50 area. And when that happens, you could get a very large-scale sell-off that we will then update on an hourly basis or as needed, based on how the market is progressing at that time. So this is a picture of the short-term S&P. You've got some, the next level down is 1299 and then 1289 and 1284. Okay, so that's the risk there to the downside. If I now go to an 89-minute chart, a little bit longer-term view, you can see over here the initial risk here is about 1298, and any boundaries, lower boundaries that you see slope down, actually act as support. So technically there's some support between 1289 and 1284 on the S&P 500 June futures. Okay, so even if we do get that sell-off and being bounded in this neighborhood, there could be a little short-term rally off of that point. The rally would be contained most likely by the 1321 to 1324 area. And then, of course, we have that overhead resistance coming off of where this market is finding weakness, which is at the 1333.75 level. Global resistance going well into June is the 1360 area, and the largest scale resistance for the next a month or so going into July is 1365 to 1380. Now, we don't have to worry about those levels for this specific trade that we're expecting to play out in here. It looks as if we're going to be bounded in this area. So if we don't break those levels that I discussed, that 13-1750 and the 13-14, then it's going to have a very hard time climbing this wall, okay, which starts out basically at a level of about 1326, goes up to 1333.75. And then you could see all the lines, the lower boundary starts sloping up as you get, into the early part of June, and as we advance into June. So it becomes critical that then, if we do end up breaking down and then bouncing back up, the next time we get underneath the lows, so we say the 1284 area, in this interval here, that could lead to a substantial sell-off, and take us well below 1250 in the S&P in a very short period of time. Now, if we go to the more distant chart on a much larger time frame, and before I actually take you to the S&P, I'm going to first take you to a global index. When I say global, I'm really referring to a large index of stocks that trade in the U.S. marketplace. It represents about 80% of the tradable market. So it's much more broad than the Wilshire Index as well as the S&P 500. And what it's showing here is that we have downside risk going into the 10,500 area, and currently we're at 12,311. So there's definitely a bear market in play. If I zoom in over here, what you will see here is we banged into critical support on this purple boundary. We have a bunch of these shorter term time frames starting to curl up, so it's not going to be acting as support anymore once you get into the first part of June. So getting underneath 11,937.90, you are then at risk to breaking underneath this red boundary, which is starting to slope up at 11,788.90. Well, when that happens and we get underneath there for 1 day or more, we're at risk initially getting a move down to about the 10,306, and then thereafter getting a move down to the bottom of this red boundary. It starts out at its lowest area in September and then rises into the middle of next year to a level of about 8,600. The base of this level is around 6,100, so you could see clearly that this is, potentially some of the tail risk here is a 50% drop in the overall equity markets, with some equities falling much further than that. Now, based on the analytics that I look at on the S&P and the Dow and the NASDAQ, it looks like there's a confluence of events that are going to be taking place at a few periods during the year that we really have to pay attention to. And those periods are basically the beginning of June, around June the 20th to the 29th. We'll have to pay specific attention to the area of around July the 3rd, and especially as we progress from July around the July 18th area into the August 3rd area. After that, we'll have to watch out for the period of around September the 25th, maybe the 23rd. So that's a key area. So if I really have to look at this red boundary, I will key off of where the red boundary is as an objective near the areas where we're expecting some of the biggest market movement. So therefore, there is potential risk down to the 6,074 area. And the final capitulation for a lot of the equities throughout the markets is somewhere between the middle to the end of February into the end of May. So, best case scenario is we get down to about 8,400, which is like a $12 stock falling to $8, and that's a significant move on an index basis. Now what I'm going to do is I'm going to take us over to the SPY, which is the exchange traded fund for the S&P 500, and what you are going to see over here is a very dangerous situation that has emerged. Currently, the SPY closed at 132.88 last week, and we came down to critical support along this purple boundary, which which this week keys off of the level of around 130.17 with outside spikes down to about 128.31. And the real danger in this market is, well, we're basically bounded by this purple boundary, just so that you know. So that even if the most positive news came out in the market, and we, let's say break out of this pivot point and get outside of that, 1330, say 5 area in the S&P 500 June futures, and for some strange reason we rally, let's say into the area on the SPYs of 135.38 to 136.65 into the beginning of June, you're going to find extreme resistance there. Let alone there's extreme resistance right around this red boundary, but it's very extreme over here. So this is the broad-based overhead resistance. And as you get into the end of June, it rises as high as 137.56. We're currently at 132.90. So I'm not actually saying that we're going up there, but I'm saying that don't get excited about any kind of resolution that the policymakers may have to what's going on in Europe, because at best that rally is going to fail at those levels, and at worst it's going to fail today if we indeed break out of that 1317 area and the 1314 area on the S&P 500 June futures. And if that happens, I'll be there right away to analyze the short-term time horizons, to provide updates on our Twitter feed at nakedswantrading.com, as well as Naked Swan Trader, to actually provide insight into how severe the next leg down is going to be. But all I can tell you right now is that taking out that 1314 area on the S&P 500 June futures correlates well with taking out this point, the 128.34. And if we stay below there for 1 day or more, we have a huge gap risk going all the way down to this teal boundary. And that teal boundary happens to be in confluence with a few other balance points at the area of about 122.78. So that's like equivalent to like 1230 on the S&P 500, which is substantially lower than the current levels. We're talking 90 points lower on the futures, and if the Dow moves accordingly, that's like a 900-point drop in the Dow, or at least that's how it would feel. Now, the real danger is that, we get underneath this black boundary. If we actually get underneath there for more than a day, and I'm not saying we're going to get underneath there right away. We may just, it's possible that the market just comes down to that 1227 area on the S&P, or the 122.77 area on the SPY, and then just muddles around. But even if it muddles around, it's going to be contained by this yellow boundary. And this yellow boundary is basically starts out, let's say we come down to this area, it starts out, let's say, at 127.63 if we initially come down to this 122.77, and then it rises as high, going into September 17th as high as 133.40, which is like, 1334, which is basically the resistance that we're actually considering as overhead resistance right now on that short-term time frame. So really this is not a healthy market. And also when we get up to this area, you can see we have a whole bunch of boundaries sloped up which act as negative sentiment for the market on a forward-looking basis. So what happens is that if sometime in September That would be the worst case scenario. It would also be quite bad if it was to happen somewhere in the middle of July, if we got underneath this black boundary, of this level basically, which is the 120-150. But if we get underneath there, if we kind of hold that level, or even if we get underneath there but just bounce back, we're going to be contained in here. And basically, the next time we get underneath 121, say 41, for 1 day or more, and come, let's say, especially come like September, somewhere between September 15th and September the 26th, if we do that, then we're at serious risk initially for a push down to the 110.60 area on the SPYs, and then the worst case scenario would be that in early December or even as early as mid-November, we get a price trading underneath 110.60, okay, for more than 1 day. Then we're initially going to push down into the 107.53, and then we get underneath there for more than 1 day. We have huge gap risk going down to the 92.15 area, and at the most extreme case, if really negative sentiment came in, we could go as low as 74.18, and that would play out somewhere between February and May of next year. So there is some very, very significant risk to the downside in the markets here. I also would like to provide you with a early warning indicator of, or a pilot light indicator of what equities you might want to look at to get guidance for a move of this amount. And what I'm seeing over here is a very, very dangerous move developing in Google. Google looks like it's very, very toppy right now. You could see there's a tremendous confluence of boundaries all sloped up, acting as resistance in the area of about 643. Now, I'm not saying you're going to get a rally to 643, but if you do, good luck. It's not going to be sustainable. And even going out over the next year and a half, it's very doubtful that you'll ever see Google above 692 again. I realize that's like 100 points higher than where we are now, but you have to consider Google is the kind of stock that just between October and December was able to move from 450 into the 600 area. Now, unfortunately, there's a few events here that are taking shape, and the event is basically this white boundary in confluence with this purple boundary. Okay, they're kind of overlapping going into the July 18th area. Okay, middle of July, and if we were to get underneath 582.68 and trade underneath there for an entire day, so I mean like the high of a bar being underneath that level, then you're at risk, in a very, very serious risk, of getting a gap down to the 482 area, okay? And basically what I'm saying is either we break that area and you go to 42, or we stay in this range, or we get a rally and then we kind of look to short the market here and expect to move down to 42. So that's a very large-scale move. You're talking to move from the 600 area down to the 480s, okay? And that's not the whole move. That's just move number one. After that move, we're going to be contained pretty much for the rest of the period below 596, going right through next year, likely, and or at least into the May period, where we're expecting a capitulation in the market. And the first wave of the capitulation would be sometime in February. We're going to come down to the bottom of this red boundary eventually in here. I mean, and most likely that's going to happen somewhere between January and May. That puts us at risk, inside the 350 to 450 area. That is an enormous drop from where we currently are. So we're talking like, potentially a 250 point sell-off from where we currently are. If we rally up into this upper range first, then we're talking up to 300 points shed off from a high point. inter-year into next year. And that is definitely going to cause an echo, a very negative echo through the technology sector, both the XLK and the NASDAQ Composite and the NASDAQ 100. Okay. Another area in the S&P 500 that has demonstrated a weakness of late is the XLY, which is consumer discretionary. It's held up strongly for an extended period, but just recently it's starting to break down. And we've got some very, very critical support areas we're going to have to watch very closely as we get into this treacherous area with the S&P potentially breaking down. That number is about 41.54 on the XLY, and if we trade underneath there for more than 1 day at any point going forward, into let's say September especially, then we're talking about a gap risk down to 35.42, and that's a very significant move in a very short period of time, considering that it would give up all these gains, and a lot faster than the number of bars it took to run it up. It would be even faster than these black bars that took it down from the high to this level. It would be more like this kind of movement, but probably maybe even twice as fast. So this is a very serious situation, okay? And this isn't necessarily an all-out crash for the XLY immediately, but later in the year, once we get underneath 33.31, and let's say sometime after December, or especially going into January and February, you get underneath there, you've got gap risk down to the next level, going into that capitulation in May down to the 23.25 area. So there is tail risk, meaning an unusual event that is many standard deviations greater than what would be expected. Just looking at the normal distribution or the bell curve, and basically you're talking about a haircut that would take you back down to levels that we haven't seen potentially since 2010 and 2009. Okay, so we'll have to watch that closely. It is one of the stronger indices. Its overhead resistance for the remainder of the year is at 47.22 plus or minus $2. The next area, obviously, that is exceptionally weak and is tied to the Dow index, and I'm just going to go back to the Dow here on the going to go here to the Dow on the 21-minute chart, the Dow futures June contract, and what you basically see over here is the market selling off from the high. There's not a great deal going on here, but the risk is that if this market kind of just treads along here and kind of causes this yellow line to start curling up and sloping up again as we progress through the next few days here, or even possibly today if we get that kind of activity, then technically, if we were to get underneath the 12,419 area, then you could get a push down to the 12,368 area. But it looks as if that's acting as support going into the end of this month. After the end of this month, as we go into the beginning of June, everything starts sloping up and looks a lot more like the S&P, where you've got significant gap risk. Now what I'm going to do is I'm going to take you to another chart over here, which is a very, very weak index, and that happens to be well, actually, I'm not going to take you to an index. I'm actually going to take you to an equity, which is Anadarko Petroleum, and it's a big name in the oil patch or in the oil space, and you can see it's had a very, very significant sell-off from the high, but it's also sitting on very unsettled ground here. The 6180 area, especially as we progress into the July area, becomes a real problem because we've got gap risk that takes us down to $40.60, and Yeah, so that would be significant, and that would definitely hurt the oil index and the energy space. And usually, one thing to keep in mind, uh, unlike in the financial futures like the E-mini, uh, the E-mini futures usually provide an early indicator of what's going to happen in the cash market, but when it comes to big name petroleum stocks, they usually are a pretty good idea of where the smart money is going, and it could give an indication of what's going to actually happen to crude oil. So we have to really watch crude oil closely as we progress, you know, into the second, third, and fourth quarter, just because some of these big name equities in the oil patch, like Anadarko Petroleum, as well as Exxon, as was mentioned in prior posts. So that's definitely something we're going to want to take a look at. Another area that we're going to want to look at as the S&P or when the S&P breaks those critical levels, and it's not a matter of if, it's just a matter of if it happens in the next day or two, or whether it happens during those periods that I identified in June and especially mid-July and late September, and then of course December through May of next year, with the first area of capitulation being somewhere into the end of February of 2013. And you can see here the S&P Chemicals Index is another index where there's very tight consolidation and resistance on the upside, huge gaps to the downside during the year. So obviously you're going to want to pay attention to the materials index, anything in there that is tied to chemicals. You're going to want to pay attention to companies like Triple M. And we're going to be releasing our flagship product shortly that is going to provide insight to subscribers on an updated and basis, so that you have a roadmap that walks you through the market on shorter time scales that allow you to maximize the longer term trend and hone in and really hone in on the support and resistance levels that apply to the market at any given time. Another area we're going to want to pay very close attention to, considering what we have been talking about at NakedSwanTrading.com for the past several weeks and months, and that basically is what's going on in Europe. And Spain is at the epicenter of the crisis. Okay, and no matter how many people say that it's Greece and Italy, yes, Greece and Italy have a problem, but the epicenter is Spain. And I have been talking about the $22.30 area as being critical support, because getting underneath that, we're going to be descending down to the bottom of this well over here, which takes us all the way down to about $4.78, just around $5. And the scary thing is, what I indicated way back when we were up over here is that it wasn't a matter of if we're going to break this point, but we're heading towards this point, and now we're finally underneath it. You can see over here the bid-ask spread before the market opens is 21.93 to 22, and the last trade in the pre-market was 21.92, which means that we have a weekly opening bar that is below 22.30. Okay, and basically what I said is that if we get a complete week that trades underneath 22.30, now the week isn't over, so it's quite possible that we can. Okay, but it's not. But that's really irrelevant, because you can see what's happening over here is this boundary that starts out at 22.30. Well, it actually did start out at 22.30. Actually, for this week, it's located at 22.97. So technically, as long as the prices trade underneath 22.97 for a full week, and I don't care if it's this week or if it's next week, and the fact is, because this yellow boundary rises into the future, that level is going to rise. So we don't have to have it trade underneath 22.93. You can see that in August it only needs to trade underneath 23.25, and in December it only needs to trade underneath 26.43. And I could tell you one thing, because we have already shorter term boundaries that are projecting well below this area and into the 21.28 area, and we already knew that last week. That's why we're already getting prices trading underneath that 22.97 area. When that happens, and it looks like it's going to happen in either this week or in the next couple weeks, we're going to be heading down very, very quickly towards that $5 area, and there's going to be an all-out crisis in Spain. And if you scroll back, you could see that this is a very, very strong pivot point. Now, a lot of times you will have pivot points that fail. Okay, you could come down to a pivot and then rally and then retest. But because we have a confluence of two boundaries that are overlapping and they're coincident with this pivot point that happens to be very, very broad, that would actually take you all the way back to where we were in the, well, actually we're expecting to go all the way back to where we were in the early 90s, okay, or lower in Spain. And the scary part is that just because the best case target is around $5 to $10 for Spain, it doesn't mean it's going to stop there, because as I said before, you only stop on lower boundaries that are sloped down, and all these boundaries are sloped up. It doesn't start sloping down until September 9th, 2016. So basically, we're going to have a real problem in the overall equity markets in that period. The next thing that we should be paying attention to is the EMB, which is the iShares JP Morgan US dollar emerging market debt. Because obviously, if there is a crisis going on in Europe, it should show up in the debt market first. And you could see over here, it does not look good for the debt market. And we have been talking about this in the crash warning that was put out on the 18th. And basically, you can see here, market tried to rally, but it rallied into a whole bunch of upward sloping boundaries. Now we're underneath all these boundaries, and it's going to have a hell of a time getting back up to this purple boundary and breaking above it. It won't be able to do that. Okay, and that purple boundary starts out at basically 112.02 and then rises to a level of 112.98 as you go into the July period. Now, because we have projections that are already descending down to the 108.93, we already know we're going to take out this critical support along this purple boundary. And when we do, we have gap risk down to here. Well, luckily, this boundary is sloped down into this period until we get into the September-October period. So again, after this period, then we have risk down to the next boundary. But at least in the near term, our risk is down to this level, which is basically to 105.68, and the last time we were there was back in in that October-December period. So whatever improvement there's been, it's going to be wiped out very quickly, and ultimately, you're going to end up going down to the 101.45. Nothing is sloped down after here, so we'll have to monitor to see on an incremental basis where support comes in. And the final area I would like to talk about is the SDY, which is the S&P dividend-paying equities. People are in search for yield, and they've been trying to go there, but unfortunately, it became an overcrowded trade, and you could see recently it has started to sell off. And that was another equity ETF that we put into our crash warning. And this is a pretty bleak situation because we've got tremendous resistance going into the 55.24 area to the 55.95 area, and you could see even longer term resistance at 56.44, and we're very, very close to there right now. And unfortunately, we have gap risk taking us down to the $48 area, and fortunately, we do have some boundaries that are sloped down going into the third quarter, but then, like everything else, after the November period into December, especially in December, you get underneath 47.22, you're talking about gap risk all the way down into the 34.64, and if it hits in May when the capitulation takes place, in 39.33. That is an enormous drop down, and that it basically is taking us back to the levels that we haven't seen since 2009. So this is a market crash that's really going to be difficult for long-term traders to play in, because it's going to be a relentless sell-off once it starts, and the retracements are going to be extremely, extremely quick, and the continuation sell-offs are going to be even more fierce incrementally on the way down. So I would really encourage listeners to come back at least once a week when we hold these weekly briefings. Usually they're held on Sunday or Monday, or after a holiday period, and and we'll give you the next brief update. But if you really want to maximize the opportunity and get actionable trading ideas with the very specific support and resistance areas updated daily at times, if there happens to be an important update, or updated on a weekly basis with a roadmap that plots it out very, very clearly in our high-definition risk map, then that is going to be a subscription service that is going to be made available to active traders as well as portfolio managers and policymakers. Okay, so that pretty much outlines what I see happening in the markets, and stay tuned to our Twitter feed as we provide updates during the day. Just one last thing I would like to mention, and that happens to be the put right index. Pretty much what that represents is that index goes down in a bear market. Why? Because when people write puts, you're basically selling puts naked, and when you sell a put, you're making a bet that the market is going to go up. But if it actually goes down, you could lose your shirt because it's open-ended risk. So obviously, those are trades that people usually don't put on unless you really have conviction that the market is going to go up. But when this index starts selling off, it means that people have less conviction that they're confident that the market is going to go up, and they don't want to take on that open-ended downside risk. So therefore, a put-right index that sells off is a very bearish development for the market. And what I'm seeing right now, and as I indicated in the past, is we have a situation where there's extreme resistance along this area over here, which is around the 1175 area, and definitely extreme into the 1191 area. And the gap risk initially is down to this 986 area, this blue boundary, and then it starts hooking up like everything else hooks up right around the December 7th area, and then after that you got gap risk down to 717, and because there's nothing else sloped down, we'll have to incrementally watch how low it could go. Unfortunately, if you scroll back to the last time you were down in the sevens, that you'd have to go all the way back to the March lows of 2009. And unfortunately, what this is indicating to me is a massive spike in volatility, and a very dangerous set of conditions that is going to be evolving as the year unfolds, and then really capitulating into the first and part of the second quarter. So I thank everyone for listening to this market update for May the 29th. ending at 7:26 a.m. Thank you.